Good morning and welcome to Investors Mortgage. My name is Amit Sharma and I'm a mortgage finance strategist at Investors Mortgage. This morning we are going to discuss an important fundamental of property investment called cross-collateralization and why you should avoid cross-collateralization. To start with, what does cross-collateralization mean? Cross-collateralization means a loan which relies on more than one property for security. That is, there are two or more properties which are security for one loan. For example, you have a home worth $700,000 and an investment property worth $300,000 with an outstanding debt of $200,000. If you default on the loan, the lender will decide which of the two properties they would like to sell to recover its debt. It may be the lender considers your owner-occupied property easier to sell and will do so if the properties are cross-collateralized. Whenever possible, loans should be written where properties are not cross-collateralized. So that means this loan is secured either against the investment property or the home, not both of them. Now, why avoid cross-collateralization? It is important to consider the structure of your investment loan security, as it is best to avoid cross-collateralization as much as possible. Cross-collateralization, also referred to as cross-securitization, is a term used when the collateral security for one of the loan is also used as a collateral for another loan. Typically, your home is used as a security not only for your home loan but also for the investment property and vice versa. If a person has borrowed from the same lender a home loan secured by the house, an investment property secured by the investment loan secured by the investment property, and so on, these assets can be used as cross-collaterals for all the loans. If the person wants to sell one of the properties, the bank may need to revalue the other property to establish that there is sufficient equity remaining. This is also a requirement for the borrower to provide new financials to satisfy the bank, that they can still afford to have the loan just against one security. Cross-collateralization provides the bank with increased level of security. They now have control over what to do with your investment property and your home. This is one fundamental question that everyone asks when they are going for cross-collateralization with the same bank, is that what's in it for you? The hypothesis or the assumption may be that there is that the bank is feeling safer, then there must be some benefit for the borrower. Incorrect. You won't get a higher LVR, you don't get better rates, the serviceability or how much you can borrow is still the same, whether you cross-collateralize or not. Cross-collateralization ties you to one bank, and the more involved you become with one bank, the more costly it will become you to unravel the whole web of cross-collateralization when you want to sell or refinance. When possible, have every loan stand by itself with as little cross-collateralization to other securities as possible. It is really simple as playing Monopoly on a real-life scale. Collect as many single titles, standalone mortgages as possible and continue your path to wealth creation. Major banks, lenders, finance brokers and originators have all promoted cross-collateralization and cross-collateralizing loans, whereby the lender uses all properties mortgaged with it as security for your outstanding loans. They also attempt to refinance all existing loans with one lender. There are a number of reasons for doing this, and none of them benefit the client. Now, the reason lender do this, in our view, are it increases the value of client's loan and the lender's fees or commissions. it locks in the clients so that all future finance must be obtained through that lender. Most of all, it removes the need to disclose the valuation amount for the investment property, because equity in the family home is used, and usually it's more than enough to cover the two loans. The property being purchased may be valued by the bank lower than the purchase price being paid. However, other properties that they